All right, so I'm going to look at some stocks that might be on sale today. And one of the places that I like to look for these are in the um, highs and lows that were after the closing. So if we go to Yahoo and go to stocks, and you can find the biggest day gainers or the biggest day losers. People who trade momentum, day gainers might be a good place to look, but people who like bargains, biggest losers of the day, which would be Friday. It's a good place to look and before the open today. So if we look at the biggest losers, let's see if we can pull it up. These were the biggest losers on Friday, and they might rebound today, or you might get a good entrance point. So this, sorry, we lost the stream there. Are we back? Say something in the comments if we're back. Uh, Tried to relaunch. Are we here? All right, we'll try this again. So, uh, we are looking at Decker stock, right? As I mentioned, with Deckers, it is an interesting idea because uh, optically it's very cheap, just like Crocs is on the surface. So it's gotten beaten up a lot now because they are their guidance. They said that they weren't going to give guidance because of what was going on with the tariff situation. And hold on, let me see if I can pull this up. What is going on here? Let me log off and try again. Okay, we're back. So this is where we are. So, as I mentioned, Crocs is a really interesting idea, and this is sort of related. So, this got beaten up on Friday, and it's a good place to look for bargains in the stocks that are down the most on a certain day. And this one is down 15% on Friday. And what happened was that their earnings came out, which were bad, but they said that they were not going to give guidance in the future on earnings because with uh, this company Deckers, which use like Tiva sandals and things like that. Uggs, which are also shoes that are very niche. They're getting hit a lot with tariff pressures, so they don't know what their earnings are going to look like. So with this one, it's kind of interesting because I think I still prefer Crocs with Uggs and with Tiva and with Hoka. They're shoes that are made with different pieces of leather or and they're sewn together, and that's pretty hard to make. And with Crocs, it's just injection molded plastic, very easy to produce, very cheap. And with the companies that Deckers has, like Tiva sandals and Hoka and Uggs, they have to keep redesigning them because it's kind of a fashion thing, and fashions change, and you don't. It's very hard to predict. But with Crocs, no one thinks Crocs are fashionable. They're ugly, but people buy them because they're comfortable, and comfort doesn't go out of style. So this is trading at 13 times earnings, which seems like pretty cheap if you think about the S&P 500 as your default alternative, and the S&P 500 normally trades at 15 to 16 times earnings, but this one is trading at 13 times earnings. So optically, it looks pretty cheap. But we do have this problem where they're getting hit with tariff pressures, and it's a fashion brand, so fashions are hard to dictate. And Crocs, I believe, is a better value because Crocs, it looks like it's trading at 20 times earnings, but it's not. So Crocs took a write down on their Hey Dude acquisition. And so if you look at the actual cash, the write down that Crocs took was a non cash write down. So it's actually trading at about 6 times free cash flow. In Deckers, this says 16, but as I said, it dropped a lot on Friday. So it's really 13. But they expect the forward PE to be 16 times earnings. So they're expecting earnings to go down. Analysts are, and that is because of tariff pressures or other things, bad economy, people buying other brands, things like that. So this is not as great a deal in my opinion. So price to sales, if this was around 2 times price to sales, I think that would be very interesting because if you can get something less than 2 times sales, in general, I feel okay about that. EV to EBITDA, this I tend to look for things that are less than 10 times EV to EBITDA, and that's just sort of a rule of thumb for me. Other things are nice here, nice operating margin, really high return on equity. So you normally wouldn't see this high return on equity on a company that's trading so cheap, especially if revenue is growing and earnings are growing. But again, that's predicted to go down, possibly because of tariffs and possibly because of the economy. So, I think there are easier ways to make a buck in this market. So if we look at the other day's biggest losers on Friday, you might get some other ideas. Gentex, don't know that one. Booz Allen Hamilton, they were down quite a bit. And A lot of the consultants are sort of having a hard time adjusting to AI because it does lower costs to them, but it also makes it harder for them to get customers because a lot of what they do uh, is market their brand name. So when a company has a problem and they bring in somebody like Booz Allen or Boston or McKinsey or anyone else, they have a team of junior analysts just looking at the problem, people 2 or 3 years out of college, and then they put together a report, and then the partner presents it. If what AI is good at is doing really passable, low level work that these guys would be doing, why are you paying all this money for what these junior analysts would do when you can get it yourself for free or for near free? So that's why they're suffering. I'm not a big fan of that. Mohawk might be an interesting one. So Mohawk makes carpet and flooring like tiles and things like that. And if you think about it, your carpets wear out, your tiles wear out, your hardwood floors wear out, and eventually they'll have to be replaced. So in terms of companies with a moat, this is a pretty good one. And Berkshire Hathaway, which is owned by Warren Buffett, they own a subsidiary that makes rugs and carpets and things like that.